Hello class, this is the second lecture for chapter 15 on lease accounting. Fun stuff here. And so remember here in the first lecture, we are trying to look at 5 criteria, decide is this a finance or lease for the lessee and a sales type lease for the lessor, meaning even though title has not legally passed to the lessee, all the substance of the transaction is as if the lessee owns the equipment and the lessor does not. So if you're not in that situation, we're in the operating lease side. And so let's look at the criteria for an operating lease. So number 1, does not meet any of the 5 criteria. Remember, you only have to meet one of those criteria and then you're in a finance lease or sales type lease. The fundamental rights and responsibilities of ownership are still retained by the lessor, and the lessee is using the property temporarily. Remember those Parts Plus stores that I showed you from Linux. 3-year leases, moving around every 3 years, finding better locations. Those properties probably have 30, 40-year lives. Linux is only taking a tiny piece of the life of that property, and they could care less about the long-term. All they care about is how good does this location and this property work operationally. And after they make the lease, they wanted the leases to be short-term so they can move if they're not working. So operationally is very good for them. And so that would be a good example of something that does not meet any of the 5 criteria, not the major part of the economic loss, not the substantially all of the fair market value for those leases. They're operating leases. And so the lessee is using the property temporarily. Now, here's what's interesting with operating leases. Lessor does nothing. He just continues to record lease revenue on a straight line basis and does not take the equipment off the books. So the lessor will continue on the books to have the equipment on their books, and they're probably depreciating that over the useful life. Keep in mind, in a finance lease, the lessor credits equipment off the books and gets rid of it, even though they may have legal title. In the operating lease, the lessor keeps that, continues to depreciate it, and just records lease revenue. So really for the operating lease, no change. Now, for the lessee, they are going to record at the present value of the future lease a right of use assets and lease payable. And this was the biggest hurdle for the FASB to cross when they want to put all leases on the balance sheet. So with these new rules, even operating leases show up on the balance sheet. And really kind of no change, just the fair market value of the lease payments, debit right of use asset, credit lease payable. That part doesn't change. What changes is going to be on the income statement side. So let's read this example here. So in this case, the Sans Serif Publishers, they're leasing this printing company from First Lease Corp. They're going to make 4 annual payments of $100,000, and the useful life of this is 6 years. So 4 divided by 6, 66%, less than 75%. So not the major part of the economic life. The present value is $348 versus $479. So far less than 90% or substantially all of the $479. So we're in operating lease territory. And so the first entry, still the same. Company is going to put right of use asset debit and credit lease payable for $348,000. Keep in mind, lessor, no entry at all. They're only going to record their lease revenue as they always have done. Now this is where it gets complicated. The big deal here, now the first payment's the same, $100,000 reduction in the lease payable and cash. So that entry doesn't change, operating lease or finance lease. Again, we're only talking lessee here, lessor. None of this applies. But here's the goal of the FASB and how you're going to see some complexity here and how this is calculated. The goal is to make total lease expense equal to the straight line payments that the company is making, as it always. So the big change for these rules was on the balance sheet side. Actually, no change on the income statement side. But we're gonna have to back into some stuff here to get to that straight line expense of $100,000. And so we're gonna go calculate interest expense like we always have done, 10% times the 248 because we paid $100,000 here. Interest expense will be $24,869. But the amortization expense, so we're going to reduce the lease payable and credit cash. Here's where it changes. The amortization expense is going to be a plug, whatever it takes to make expense on the income statement equal $100,000. And so if whatever this will change in future payments, this amount will change. The total will always stay the same. So we're going to have, I think there's 4 payments here. There's going to be 4 calculations of expense equal to the $100,000 they paid. And so the goal here by the FASB is to make an operating lease on the income statement act just like it always has on the income statement with rent expense. However, the whole big change is now in the balance sheet, investor can see, hey, the full amount of all lease obligations that were never there in the past. So that is a big deal. So so we're going to have more expense with finance leases up front because of the interest and that. So operating lease, so a finance lease is going to reflect more of a financing of that asset, and we're going to have interest expense. And so with a greater lease obligation in the earlier years, we're going to have more expense in early years with a finance lease and less in the later. However, an operating lease, straight line expense all the way through, just like it had happened before. Now, there is a shortcut method. That's one of the problems which a lot of constituents and registrants with the SEC push back on the FASB that, man, I've got to go out and find every forklift, every copy machine all over the world, big global companies. Shouldn't there be some de minimis requirement? The FASB said no. Funny thing, the IFRS allowed some de minimis requirements. If it's a small lease, don't worry about it. FASB was worried the companies would play too many games and try to avoid putting these things on the balance sheet. So there are no de minimis. Every lease must be captured. Think about the Sarbanes-Oxley controls. Maybe you're in an auditing class or you'll be taking auditing in the future. Auditing companies and management teams have to evaluate the internal controls over a company. And there's one aspect, one objective internal controls is called completeness and accuracy. How do you know, and I used to get a lot of challenges from my auditors on this, how do you know you have everything? Do you have a complete record of all your leases and when you calculate your lease obligation and your right of use asset? That's hard. I don't know what I don't know. If I knew about it, I'd put it on the books. But we have to have controls, be able to make sure we capture everything in every corner of the globe. And so that's one of the challenges of this pronouncement. However, the FASB did allow one break, and it's optional, don't have to do it, and that is if the lease is less than 12 months, don't do anything. Just record rent expense. Don't put it in your right of use asset. Now, I think you also still have to disclose that amount, so it's kind of hard not to have to. If you have to do it anyway, you might as well. But companies have an option to use the shortcut approach, but it only relates to leases that have terms less than 12 months. So that's kind of interesting. Leasehold improvements, this is no change from prior county, but if you go back and you think about these Parts Plus stores, maybe I'll go back and look at that picture of it. You have to go way back to the beginning slide. Here, look at this Parts Plus store here. what Lennox is leasing here are only the 4 walls and the floor. All this other stuff, like these shelves, that countertop, they weren't there. Lennox had to go buy those and put them in there. And those are called leasehold improvements. It's an asset. It's not part of the lease, not brought into consideration in the fair market value. There's no lease payments on it. It's like any other asset but it's part of assets placed into a lease. And so all of this is going to be depreciated over the useful life of that, which may be the lease lease term, because you might not be able to use it in the next property. So if you think about, if you walk into a Best Buy, most likely their locations are leased. Man, there's a lot of beautiful Best Buy. You got Apple, picture of Apple products, and a lot of signage around, they're trying to generate excitement. All those are leasehold improvements that what Best Buy lease was just a shell of that building. And so these leasehold improvements, let's get back to the leasehold improvement slide. So they're recorded in asset accounts and depreciated over their useful life. So no big complexity here. Lease disclosures, oh my God, they are cumbersome, they're voluminous. I am so happy I'm teaching lease accounting versus doing lease accounting right now. So much has to be disclosed, and you have to continue to evaluate these leases throughout their life. And so just think everything that you could disclose, the companies are having to disclose now, and that's part of the craziness around lease accounting. Well, class, that is chapter 15. I'll work some problems in the next lecture for 15, and thank you for your time.